What are the main causes of cash flow problems? Cash flow is oxygen, profit is food, but guess which one kills faster? Your business might be bleeding cash, and I'm going to show you where it's leaking out. By the end of this video, you're going to know the RAGE S.L.I.M pants process that will actually stop cash leaks. Remember I said cash flow is like oxygen, but profit is like food? Listen, I wouldn't want to do it, but you can live for weeks without food, but you can only live for minutes without oxygen. I want you to think about, it's kind of a strange metaphor, but think about your business as a bathtub. The faucet is revenue. That's where money comes in. The drain is your expenses. In many businesses, what we have is we don't have an appropriately sized drain for the faucet that's coming in. Many times, the front door is a lot smaller than the back door, or in this metaphor, the drain is way bigger than the faucet. Or put it in a health format, cash flow is like blood pressure, profit is like your weight. You can be in pristine weight condition and still have a heart attack because of bad blood pressure. So what we want to do is we want to go to solve the unseen things, the cash flow things that a lot of times we stick our head in the sand as it relates to small business, and we just go, hey, my CPA does that, my accountant does it, whatever, move on, and as long as there's money in the bank, then I must be making money, right? That is one of the biggest myths of business ownership, and we need to quell it right here. So in any business, we want to run lean, and dare I say, we want to run in our slim pants. That's where we came up with the metaphor. But I'm going to walk you through, and these acronyms will be such a visual help for you. In fact, you can take this acronym from this video that I'm walking through, and you can take it right back to your team and start asking yourselves the question around this acronym to start solving these cash flow problems. And in order to solve them, we're going to track the slim pants, but first, we're going to rage about this. What do I mean by that? Well, we want to outrage ourselves with our heads being in the sand around the money. We want to take our heads out of the sand, and we want to go, wait a second, we're going to do something different. We're going to focus on this thing. And so let's start with our acronym of RAGE. So RAGE stands for revenue, actual cost, gross margin, and expenses. In any business, we got to know what the revenue is, because without revenue, we can't drive any part of the ship. And then from there, the actual cost could be actually a little different than the expenses, because we've got like cost of goods that are associated with this that are a lot of times are not caught in the expenses. So many times it matters what your accounting is calling an expense. For most businesses, you've got a cost of goods category, and that's a cost of the actual good that you have to have in order to sell the product. But in the same business, you also have a category of expenses. So those are non-cost of goods expenses, or what we call above the line and below the line with those sorts of things. We need to be aware of both. So what's the revenue? What's the actual cost of goods on this issue? What's the gross margin? So what is that? That's our revenue minus cost of goods. Gets us to the gross margin, so we call that real revenue. And then from there, we take out our expenses, what actually runs the day-to-day. The things that aren't going to change regardless if we have business or not, the overhead, the expenses, the rent, the internet, the personnel, that sort of thing. So once we have identification about the RAGE, then we can start to run our business from a slim pants standpoint in the metaphor and see how that works. But before I go into the slim pants, let me ask you this question. Do you know these? Could I come up to you and go, hey, what's your ballpark revenue? What's your ballpark actual cost of goods? What's your ballpark gross margin? What's your ballpark expenses? If you don't know those, we've got to start there. And at least once a month, you need to be pulling a profit and loss statement. We look at money in three forms: past, present, future. The past is your balance sheet, your profit and loss statement, and any sort of cash flow reports or any reports you pull from a bookkeeping service. And so with your profit and loss statement, we're looking here to see what is our revenue. What are our cost of goods? What's the gross margin, and what are the expenses? You as the owner and the leader need to be aware of those numbers, because those numbers are what help drive good decision-making moving forward. And the good decision-making is what's going to modulate the business so you don't run into cash flow problems. Now, you could be sitting here and thinking, well, Scott, yeah, we're only $2 million or $10 million a year or $50 million a year. Good. It doesn't matter your revenue size. Everything that I'm walking through matters regardless of the size of your business. Now, that leads us into the slim pants methodology of being able to identify the main causes of cash flow problems. So let's walk through this. Ready? You've got to know your revenue, actual cost, gross margin, expenses, so that you can track schedule, labor, inventory, and the mistakes or the callbacks in your business. These right here are some of the biggest drivers of cash flow issues when we don't understand the schedule. You know, we'll get a lot of employees that say, well, why does it matter if we get it done on time if we just get it done at all, because we'll get the billing regardless? And what many people don't understand is overhead comes every single month. It becomes every week. We owe things recurringly every month on this. And so if a schedule of a particular service or product pushes out a month, 2 months, 3 months, all of a sudden our overhead is skyrocketing at that point. We have got to obsess over schedule because schedule directly ties back to cash flow. That also leads into labor and watching our labor cost. And too many times we go, hey, we need a person to go do this, and then we just go to the market and pay them whatever, quote, the market says that we should pay them, or whatever a Google search says that we should pay them. No, your labor numbers need to depend on the revenue that comes in. This is why you've got to know the RAGE side of this, is because when you look at your labor numbers, they've got to fit in with your expenses that are tied into your actual cost under the revenue that you get. And so one of the biggest effects and drivers of cash flow problems is not only scheduling, but overextending yourself on the labor. That then leads into inventory and mistakes. Now I'm going to skip over inventory because that's not every business that we talk to, but mistakes happen in every single business. And we have found it to be a driver of anywhere between 1 to 4% of revenue that people can spend out that they did not budget for based on mistakes and callbacks. You have a service provider, you're a pressure washing company, and you go out and you're pressure washing somebody's house, and then you blow a fuse which blows something else, and now they've got to call an electrician for $1,000, and you just blew the entire project on that one mistake. And so we see this cost driving so much of cash flow problems because it's not budgeted. It's not that we're going to eliminate 100% of these. It's that we need to budget for them when we're accounting for it in the expenses. Again, that's why we need to know above this line up here in our revenue, actual cost, gross margin, and expenses. And so when we're fitting into our S.L.I.M pants, let's remind ourselves to look at schedule, labor, inventory, and mistakes. That then ushers us into some of the secondary problems of understanding what preeminates cash flow issues. And so if we look at it like this, what we're looking at is pricing, accounts payable and receivables, new equipment or capital expenditures, taxes, and then servicing debt. As you're running your business, one of the things that I want you to go back, in fact, after you're done with this video, go back and look right away. How have we come up with our pricing for our service or pricing for our product? Have we literally thought through what are the actual expenses per product? What are the actual costs per product? And then run that in with the revenue per product so that we understand both pricing and profitability per product or service offering when we're serving a client or a customer. But too many times we just kind of put our finger to the wind and make that number up, and we have no idea if it's profitable or not. That leads us into getting paid and paying much quicker. That's our accounts receivable and accounts payable. Again, one of the biggest drivers of cash flow problems is you're not getting money fast enough, or the money that you're getting in, you're not appropriately paying it out in a timely manner, so it builds up over time, and now you owe these huge chunks of money at differentiating intervals along the business. And then I want you to think about this with the N, the new equipment or the capital expense. How many times has a team member come to you and gone, hey, can we get a new van? Can we get a new computer? Can we get a new, you fill in the blank? And what's our theoretical method of going about and doing it? We kind of look at the bank account, we go, yeah, there's money in there, I guess, because we're running our business out of 1, 2, or 3 bank accounts. And then they go buy the thing. And then when it comes time that we actually needed that money for this thing over here, now we're short on cash flow because we don't have a budget for new equipment. And we don't have a bank account for it. When we ask you to subdivide your bank accounts, one of the accounts we want you to have is a capital expense account so you can start funding that account. And when you need new equipment, when you need new capital reinfusement and reinvestment back into the business, there's the account for it right there, and you know exactly what you can spend on it. You know, that leads to the T, or taxes, and one of the biggest surprise we're still bumfuzzled that we get as advisors to our clients is somewhere around November, December, the CPAs will start calling our clients and going, hey, congratulations, I looked at your P&L, that's your paper profit, not your bank account profit. I looked at your P&L and it said that you're profitable this year. And you look at your bank account and you're like, where's the money? Well, when you're paying attention to your taxes, it means you have a tax account set up at your bank. So you got tax, new equipment, capital expense. You've got a variety of different accounts that you can look at. And when you've got this tax account in there, you know exactly what your quarterly estimated taxes are that you're paying because it's a percentage of every dollar that comes into the business from the revenue number up here. But too many of us just sort of wing it throughout the year, hope we're paying enough, and then we get the surprise phone call in November and December, and our CPA tells us, hey, I just need a check for $63,472 by the end of next week so that you don't go to jail. Now, I know they give you time, but you don't want to live under that stress and pressure. So we need to be aware of our tax liability all throughout the year, not just the payroll taxes, but the quarterly estimated taxes as well as we're looking at that. Well, Scott, won't that affect the net income of what's going on up here? Of course, but we don't want to unnaturally affect that. Too many CPAs want you to buy stuff at the end of the year so that you can offset your tax liability. But here's what they usually don't understand. Number one, you don't need the thing you're about to buy. So it's not really qualifying under the new equipment right here. And number two, once you buy the thing, let's say a truck, you buy a truck. Well, now what you do, number one, is you lost your cash, so you no longer have access to that cash. Well, Scott, I'm saving money. I would rather you had that cash at 60 cents on the dollar than to go buy a truck that you now have to insure, you have to fuel, you have to maintain, and you have to depreciate over time, which could help you in the near term on the taxes. But you told me that your CPA said that it's going to save you money. Where's the money? Is it in an account somewhere? That rarely happens where we talk to a business owner where they go, oh, and I have this remaining check for what I did because of the money I saved in taxes. Well, you could argue, isn't it in the account? No, you probably spent it because that's what we do as human beings. So before you randomly buy things at the end of the year to offset your tax, make sure that it's fitting a strategic mold around what you need to enhance your pricing, to get paid faster or to pay faster, to reinvest into new needed equipment, or to come over here and service any additional debt. See, that's the last element of this thing that we need to talk about, is too many of our revolving lines of credit just continue to revolve perpetually over and over and over again. And all of these lead and set yourself up for cash flow problems. So let's go back through it. We're going to RAGE, we're going to know our revenue, our actual cost, our gross margin, and our expenses so that we can stay away from these things that are going to cause cash flow problems. Here's what I want you to do. I've got a next step for you that I think will be really, really helpful to set you up for success so that you can be aware from this. If you go down in the description link below, we've got a link down there called solvecashflow.com. And it's a handbook that our team has made to walk you step by step through how to subdivide your bank accounts, begin to track your accounts, your bookkeeping, and your customers all on the same sheet, and then to have those regular touch points so you're communicating this, not sticking your head in the sand, but keeping your head up, illuminating both the past, present, and future of money so that you can be liberated from chaos to make time for what matters most.